It's Friday afternoon. An employee just asked when they're getting paid, and the spreadsheet with their hours has a formula error somewhere in the middle. The payroll deadline is in 2 hours. 1 out of every 3 employers in the United States makes a payroll error every year, and each one of those mistakes costs an average of $291. That doesn't include the IRS penalties, which escalate fast and compound if the problem goes uncorrected. This video walks through the entire payroll process from the first step to the last, so that Friday afternoon panic never has to happen again. 6 million small businesses in the United States run payroll. 41% of those owners handle it themselves, without a dedicated HR person, without a payroll department, and in many cases, without any formal training on how payroll actually works. The average small business owner spends 260 hours a year on payroll tasks. That's 6.5 weeks of full-time work spent calculating paychecks and filing tax forms, instead of building the business or serving customers. And the stakes aren't small. Payroll tax compliance errors cost businesses over $7 billion a year nationwide. That's not a rounding error. That's the cost of getting something wrong that the IRS treats very seriously. In small business communities online, the same frustrations come up over and over again. Owners describe payroll as scattered, with data in one place, tax forms in another, and no clear picture of whether anything is actually correct. One business owner, managing employees across 6 states, said the amount of compliance mail alone was mind-blowing. Another business ran payroll for 56 workers on a spreadsheet with 379 columns for years, because no one felt confident enough to change it. And in 2026, the environment is getting more complex, not less. The Social Security wage base increased from the previous year, which means last year's withholding numbers are already wrong. 19 states raised their minimum wages on January 1st. 3 new paid family and medical leave programs are launching. Pay transparency laws are now active in 17 states. The IRS is tightening electronic filing mandates, pulling more small businesses into digital reporting requirements. This is not a problem that's going away. It's a problem that rewards understanding. Before running payroll for the first time, 5 concepts need to be clear because every step in the process depends on them. First, gross pay versus net pay. Gross pay is the total amount earned before any deductions. For a salaried employee making $52,000 a year on a biweekly schedule, gross pay is $2,000 per paycheck. Net pay is what actually hits their bank account after federal taxes, state taxes, Social Security, Medicare, and any voluntary deductions are subtracted. Confusing the two is one of the most common sources of early payroll errors. Second, employer side taxes. This is the one that surprises first-time employers. When an employee earns a paycheck, taxes are withheld from their pay, but the employer also owes a separate matching amount. Social Security at 6.2% and Medicare at 1.45% are matched dollar for dollar by the employer, adding 7.65% on top of every employee's gross pay. 2026, Social Security applies on earnings up to $184,500, up from $176,100 the year before. A $50,000 per year employee costs the business an additional $3,825 just in employer payroll taxes before benefits, workers' compensation, or unemployment insurance. Third, tax deposit schedules. The IRS doesn't wait until the end of the year to collect payroll taxes. Deposits are required throughout the year on a schedule the IRS assigns based on total tax liability. If the liability in the look-back period was $50,000 or less, deposits are due monthly by the 15th of the following month. If higher, deposits are due semi-weekly within 3 business days of the pay date. Missing a deadline is not a warning situation. Penalties start at 2% for being 1 to 5 days late, climb to 5% at 6 to 15 days, 10% beyond that, and 15% if the amount remains unpaid after an IRS notice. Fourth, multi-state withholding. If an employee works in a different state from the company headquarters, taxes are generally owed in the state where the work is performed, not where the business is registered. Even a single remote employee can trigger registration requirements, withholding obligations, and filing deadlines in their state. States are actively cross-referencing payroll data to identify non-compliant employers, and the penalties for ignoring this are real. Fifth, worker classification. Employees receive W-2s, and the employer withholds and deposits taxes on their behalf. Independent contractors receive 1099s and handle their own taxes. The IRS determines classification using 3 tests: behavioral control, financial control, and the nature of the relationship. Misclassifying an employee as a contractor is one of the most expensive payroll mistakes a business can make because it triggers back taxes, penalties, and potentially years of unpaid benefits. Those 5 concepts are the foundation. Now, the 7 steps that turn them into a working payroll process, from the first registration to the last filing of the year. Step 1, get the EIN and register. An employer identification number is applied for at irs.gov. It's free and approval is instant for online applications. State registration for tax withholding and unemployment insurance follows, and a dedicated payroll bank account should be opened to keep business and personal funds completely separate. This step takes 1 to 2 hours for the federal side, with state processing ranging from same day to a few business days. Step 2, collect employee paperwork. Every employee needs a completed W-4 for federal withholding elections, an I-9 for employment eligibility within 3 business days of their start date, the applicable state withholding form, and direct deposit authorization. This takes about 15 to 30 minutes per employee. Step 3, choose a pay schedule. Biweekly is the most common option used by 42% of small businesses. Weekly is second at 33%. Some states mandate minimum pay frequency, so checking state requirements before deciding matters. Biweekly means 26 pay periods per year, not 24, and that distinction changes every annual calculation. Step 4, calculate gross pay each period. Salaried employees have their annual salary divided by the number of pay periods. Hourly employees have hours tracked and multiplied by their rate, with overtime calculated separately for anything over 40 hours in a work week. This step is where accurate time tracking makes or breaks the process. Step 5, apply deductions in order. Pre-tax deductions come first, including health insurance premiums, traditional 401 contributions, HSA, and FSA. Federal income tax withholding follows calculated from the employee's W-4 elections and IRS Publication 15T tables. Social Security at 6.2% and Medicare at 1.45% are withheld next. State and local taxes apply where required. Post-tax deductions like Roth 401, K contributions, and wage garnishments come last. The result is net pay, the amount that hits the employee's account. Step 6, make tax deposits on schedule. Federal deposits go through the electronic federal tax payment system, which is required for electronic deposits as of 2026. Monthly depositors pay by the 15th of the following month. Semi-weekly depositors pay within 3 business days of the pay date. State deposit schedules vary and need to be tracked separately. Every deposit should have a confirmation receipt saved. Step 7, file returns and issue forms. Form 941 is filed quarterly, due the last day of the month after the quarter ends. Form 940, the annual federal unemployment tax return, is due January 31st. W-2s to employees are also due January 31st. All payroll records, including W-4s, pay stubs, timesheets, and deposit receipts, must be retained for a minimum of 4 years. The research behind this video surfaced 10 recurring payroll mistakes from business owners, accountants, and tax professionals. Mistake 1, using last year's tax rates. The Social Security wage base changes every year. Using the previous year's number means under-withholding for higher-earning employees, and the employer ends up owing the difference plus corrections. Updating all tax tables in January is not optional. Mistake 2, misclassifying workers. Paying someone as a contractor when the IRS considers them an employee triggers back taxes, penalties up to 100% of the taxes owed, and potentially years of unpaid benefits. The three-part test exists for a reason. Mistake 3, missing deposit deadlines. The IRS penalty clock starts on day 1 and escalates automatically with every week the deposit remains late. Setting up reminders or using software with automatic deposits eliminates this entirely. Mistake 4, ignoring multi-state obligations. As covered in the concepts section, even one remote employee creates obligations in their state. The consequence of ignoring this is real because states are actively cross-referencing payroll data and identifying non-compliant employers. This mistake gets more expensive every year as more states add new requirements. Mistake 5, not tracking overtime. The Fair Labor Standards Act requires 1.5 times the regular rate for non-exempt employees over 40 hours per week. Department of Labor back pay claims can reach back 2 to 3 years. The salary threshold for exemption is $58,656 annually in 26, and not every salaried employee meets it. Mistake 6, paying employees late. Cash flow crunches happen, but late paychecks create immediate trust damage that takes months to recover from. Some states impose daily fines. The fix is maintaining a 1 payroll period buffer in the payroll account. Mistake 7, late W-2s and 1099s. The January 31st deadline carries penalties of $330 per form for late filing and $660 for intentional disregard. Starting the data gathering process in December prevents the January scramble. Mistake 8, mixing personal and business accounts. This is a top IRS audit trigger. Keeping payroll in a dedicated bank account is a simple step that makes every other part of the process cleaner and easier to defend. Mistake 9, forgetting employer-side taxes. The employer match covered in the concepts section is a real cost that many first-time employers don't budget for. Adding 10 to 15% on top of gross salary when projecting hiring costs prevents the surprise. Mistake 10, not keeping records long enough. The IRS requires 4 years of payroll records. Without them, defending against an audit becomes significantly harder. Digital or physical, the records need to be retained. Everything covered in this video can be done manually. For a business with 1 or 2 employees and a single state, a spreadsheet and the IRS tax tables can technically get the job done. But once the team grows past a handful of people, or employees start working in multiple states, or the time spent on payroll starts eating into the time needed to run the business, software makes this dramatically easier. Tools like Gusto, Rippling, and ADP Run handle the calculations, tax filings, direct deposits, and state registrations automatically. Small business owners in online communities describe Gusto as taking about 5 minutes to process, down from hours of manual work. The pattern across all 3 tools is consistent. What used to consume an afternoon becomes a task that fits between 2 meetings. A full comparison of the best payroll software for small businesses is available in a separate video. The link is in the description. 3 things to do this week. First, audit the current payroll setup. Walk through the 7 steps covered in this video and check each one against what's actually happening in the business right now. Are tax tables updated for 22/6? Are deposits happening on schedule? Are records being kept for 4 years? Second, check multi-state exposure. If any employee works remotely from a different state, verify that the business is registered for withholding in that state. This is the mistake that catches the most small businesses off guard and the one where penalties accumulate fastest. Third, decide whether the current process is sustainable. If payroll is taking more than an hour per pay period, or if the team is growing, this is the point where software pays for itself in time savings and error reduction alone. Next week, We're covering the best payroll tools for small businesses side by side, comparing features, pricing, and what real users actually say about each one. Subscribe so that video shows up in the feed when it goes live. And if there's a payroll question this video didn't answer, or a mistake that should have been on the list, drop it in the comments. Every comment helps shape the next video.